everybody, it's Brenda Christ with Movement Mortgage. It's time for my Monday mortgage series. Today I wanted to talk to you about the 10 things that you need to know before buying a home. The first thing that I wanted to talk about was don't max out your credit cards. I know that it is January and all of the bills are coming in from the holiday season and that some of the damage is already done, but you want, when you are at 50% of your balance, you get some points in the credit algorithm. When you're at 30%, you get more points. And when you're at 10%, you get the max points available. So you want to be down at that 10% range of your credit available line. So that being said, it may be better to take those bills and wrap them into an installment loan. Installment credit and revolving credit affect your credit algorithm completely different. So yeah, if it's possible for you to take out an installment loan and pay off your revolving credit, it actually is better for your credit score. All right, number 2, falling behind on your payments. If you do wind up in a situation where those bills are coming due and they're a little bit more than you expected, you are way better off with that going to an overdraft account. So have your payments set up on automatic payments and have an overdraft protection set up. You know, it may look negative on your bank statement, but it's better than a late payment. Any payment that's late in the last 12 months kills your score. And it also means that you cannot get a mortgage at a 580. You have to be a 620 if you have late payments in the last 12 months. So yeah, don't fall behind on your payments. Set up auto draft. Number 3, student loans. Student loans are often in deferment, and when I see late payments on a credit report, more than likely the explanation is they came out of deferment, no one told me, they were reporting me late and I had no idea. If you call a student loan company and you say, hey, you know, you reported me late and no one told me, they're going to say it wasn't our responsibility to tell you. It's your responsibility to know when your loans are coming out of deferment and to make sure that an income-based payment is set up. So don't wait. Call your student loans, find out when they're coming out of deferment, be proactive, because when one student loan is late, it's not just one. It usually within that one, there may be 15 tiny loans and they report all of them late. So it really dings your score for a long time. And I hate seeing that happen to people. So number 3 is student loans. Number 4 is save for down payment. A lot of times people think that they can get these down payment assistance programs and they don't need any money in the bank. And to some extent that's true, but even when you are getting down payment assistance, they want to see at least one payment left over in your account after all closing costs are satisfied and down payment requirements. So save some money, have something set up where you're pulling systematically out of each and every payment that's going into a savings account. Now this could be a 401k, that's a perfectly okay form of savings, but you do need some sort of systematic savings going on. So if you haven't started that already, get that started. That's number 4. Number 5 is closing an account. It is not ever a good idea to close an account. If you have a credit card that you have paid down, fabulous. If you don't owe them any money, that's great. It doesn't hurt you at all leaving it open. It does hurt you if you close it. And the reason why is because your credit utilization is based on your available credit and then how much you owe. So if you have more than one card, they take all of your available amounts and add it together, and then they take all of your balances and add them together, and they divide those two. And that's just revolving that we're talking about. Number 6 is switching jobs. It's not entirely bad to switch jobs. If you switch and you're going from a W-2 job in one industry and you're going to another W-2 job in the same industry and you're making more per hour or more salary every year, that's fantastic. No one is going to fault you for that. And you really don't need to have a lot of time on the job if that's the case. When it becomes a problem is when you switch from a W-2 position that's 40 hours to maybe a job where it's variable income, then that's a problem. The underwriter wants to have at least 6 months on the job to see how your income's going to fluctuate. And if you go from a W-2 job to a self-employed, that's also a problem, because then we need a 2-year history. We have no idea how you're going to perform as a self-employed person, and they don't take into account what you're earning based on a profit and loss. They need to see an actual year-end tax return to see what you've reported. So number 6 is switching jobs. Oh, and if you bounce around a lot, even if you're a W-2 employee, they don't like to see more than 3 jobs in the last 2 years. So unless you're really going to a position that's going to better yourself and in the same line of work, hold off until after you get your mortgage and then switch jobs. All right, number 7, major purchases. If you go out and you purchase a car or a large furniture purchase, any large purchase, it's going to ding your score for 4 months. And it's not that you are paying late or you're paying bad. It's just that the algorithm is set up so that it pulls your credit down to temporarily discourage you from going out to get more credit until you get used to those payments. Once you're used to those payments, then it's okay. Your score will start coming back up again. But until that time, the credit report algorithm will definitely pull your score down initially for about 4 months. So hold off on major purchases until after you close on your home. That was number 7, major purchases. Number 8, this might be a touchy one for some people, but marrying somebody with bad credit. This may not be a conversation you have beforehand, but it's something to definitely consider, because if you're going to use both your incomes, you also have to use both of your credit scores, and that may be a surprise. So have that conversation. You're welcome to call me. I'm happy to pull your credit for you and give you a plan to improve your score. But yeah, if you are wanting to purchase a home and both your incomes are going to be on there, you need to know what both of your scores are. So let's have that conversation. Number 9, co-signing. It's not that co-signing, I don't want to say that it's good or bad. I'm just going to say that it can affect you. Know that when you co-sign, that payment is being counted against you, because if they stop making their payments, you're responsible for making their payments. And also, if they stop making their payments, it's going to ding your credit. And so you really need to be seriously having a conversation before you agree to co-sign for somebody. I've co-signed for all 3 of my kids, and each time we had a serious discussion about what this can do to my score, what that can do to their score, and that they were going to have a plan in place to make sure that that was paid before anything else right off the top. And yeah, Mom was not going to be happy if there was any kind of issue there. And to tell me if there was any kind of issue there so that I could make sure that I didn't have an occurrence on my report. If you are going to apply for a mortgage and say, hey, I don't make those payments, I don't want that to be counted in my debt ratio, we need to make sure that the person that is making the payments is doing it via check or some type of trackable item. Money orders are really hard to source. So I would say if you are going to co-sign for somebody, you need to make sure that they're going to pay by check and that they are perfectly okay with giving you evidence that those payments have cleared their account. And they have to have made 12 payments before we can say that we're not going to count it and that somebody else pays for this and we are getting documentation to show they're paying for it. So if you're planning on buying a house in the future, don't co-sign for anybody, and make sure that they are going to be able to make 12 payments before you are going to be looking at buying a home. Let's see, large deposits. Number 10, large deposits. We need to be able to track any large deposits. So it needs to come from a check, and it also needs to come from somebody that's willing to give you a bank statement or documentation to show where that money came from. If that money has sat in your account for 2 months, then we don't need to ask any questions. But we need to have 2 bank statements with no deposits on them. So in essence, you're going to be looking at 4 months then. If somebody put a large deposit in your account, you have to wait 2 months for it to clear and be sitting in that account, and then you're able to give us 2 months of statements. So large deposits are number 10, and number 11 is investments. If you're considering buying an investment property, you need to know that you need to have 20% to put down. And this needs to be your own money. It cannot be a gift. It cannot be borrowed. The only source that would be acceptable is an equity line. If you had another property and you were pulling an equity line, then that money is secured by another property. You could use that. But you need to have 20% of your own money in a personal account, not a business account, and then that would be acceptable for a down payment on an investment loan. So those are actually the 11 things that you need to know before buying a home. So this is Brenda Christ with Movement Mortgage. Feel free to give me a holler. You can email me at brenda.christ@movement.com, or you can apply on my website at www.movement.com/brenda.christ. So yeah, reach out to me. I'm happy to help. Have a great day, guys.